So here's the question. Is aligning your corporation with some big, emotionally resonant cause just a nice gesture? You know, a kind of ethical corporate charity?
Or is it something else?
Or is it now a cold, calculated, and frankly, an absolutely necessary business strategy in this hyper-digital age?
It's definitively the latter. I mean, if you look at the deep analyses of cause-related marketing, particularly the work coming out of Switzerland,
Hmm.
the narrative just shifts completely. We are not talking about simple goodwill anymore.
And that really sets the stage for this deep dive. Our sources, and we're drawing heavily on the analysis of economist Dr. Pooyan Ghamari here,
Right.
they argue that cause-related marketing, or CRM, isn't just being used to, burnish an image.
No, it's being used as a serious economic hedge.
Exactly. So the core mission today is to unpack how that pivot works. How do you translate something intangible like trust into tangible loyalty and, well, ironclad investor confidence?
Something Ghamari calls a calculated pivot in the digital economy.
Okay, let's unpack this. Before we get too deep into the macroeconomics, how does Ghamari even define cause-related marketing? And why is this strategic approach so critical right now?
Essentially, CRM is tying your sales or your business operations directly to a social good. And the research makes it really clear why this is so vital right now.
Which is?
In the current era, trust is the scarcest currency. I mean, think about it. Consumers are they're weary of traditional advertising and corporate messaging.
Right.
So CRM elevates the brand image by tapping into this powerful psychology of a shared purpose. And that process, it turns what were once just passive buyers
It's advocates, right?
into vocal advocates. It builds immediate brand fortitude. And we can already measure this shift. Recent consumer surveys show that 77% of shoppers now actively gravitate toward companies that are clearly pursuing these corporate social responsibility initiatives.
So they see them as more authentic.
More authentic and, crucially, more forward-thinking in a volatile world.
And the data doesn't lie when it comes to the return on that investment. I mean, take the powerful Patagonia example. This wasn't just a PR stunt.
No, not at all.
They publicly pledged to donate all of their Black Friday sales to environmental groups. They've raised over $100 million over the years.
A huge number.
But the real insight isn't the money they gave away, it's what they retained. Their repeat purchase rate soared by 25%. That's a significant competitive advantage, rooted entirely in a mission that consumers could see and verify.
That's the key part, verifiable.
That's a compelling financial result. But if a shared purpose is the main driver for consumer choice, what does this values-led thinking mean for how companies need to rethink, say, their standard loyalty programs?
Well, it means that generic points-based loyalty programs are increasingly falling flat. The market pulse from the latest consumer behavior trends, looking toward 2025, it reveals a significant hunger for empathy.
A hunger for empathy. I like that phrasing.
It's true. We see that 42% of European consumers reported warmer views of brands that emphasize these genuine, values-led narratives. And that's even amid a broader skepticism toward big corporations.
So shared value is stickier than a discount.
Much stickier. It creates a longer-lasting connection than a 10% discount ever could. And the measurable gain backs this up. Cause-aligned efforts can boost overall customer retention by 20 to 30%.
Wow.
That level of performance it significantly eclipses what traditional generic loyalty systems deliver.
The definitive case study here has to be Dove. The Real Beauty campaign, partnering with self-esteem nonprofits, is a staple of this strategy.
Classic, yeah.
That effort generated $1.5 billion in incremental sales. And if you track the sentiment scores, the ones reported by services like Nielsen, that commitment resulted in a 40% rise in positive sentiment. So when perception shifts that dramatically, you drive verifiable financial gains. It's a direct line.
It is. It connects the bigger picture of financial health. Social responsibility is now functioning as a hedge against market distrust.
Which is crucial right now.
It's absolutely crucial in an economy facing, lingering inflation and geopolitical tensions. Investors are realizing that trust equals stability, so they're prioritizing these metrics.
And there's data on this from the investor side.
Oh yeah, concrete data. Looking at investor performance from 2024 through 2025, the ESG funds, those specifically investing in environmental, social, and governance-compliant firms, they actually outperform traditional benchmarks by 4 to 6% annually. Brands that are leading the charge on verifiable causes, like climate action, they see their investor confidence spike because it signals stability and long-term foresight.
And it seems like that confidence is being institutionalized by regulatory shifts, too.
It is.
I mean, in 2025, you have EU directives mandating transparent CSR reporting. The analysis shows that brands ignoring these cause-related ties, they risk a very real 15% dip in investor appeal.
Just for looking unprepared.
Just for looking unprepared or opaque. Conversely, the incentive to embrace this is powerful. The sources indicate that 79% of consumers are willing to pay a premium for products from socially responsible firms.
Which creates a virtuous cycle of capital inflow. Exactly.
Yeah.
The result is that companies are harvesting a loyalty that translates directly into engagement. I mean, look at Ben & Jerry's. Their voter mobilization drives, done with organizations like the ACLU. They consistently drove a 12% engagement lift among their audience. It shows the audience expects them to stand for something. They reward the brand when that advocacy is authentic and action-oriented.
So that brings us to the practical application. If you're a CEO or a leader listening right now, what does the research recommend for corporations that are eyeing implementation, especially when you're navigating the complexities of the digital economy?
The key, according to Ghamari, is embedding purpose directly into the brand's digital footprint. That's essential for what he calls architecting resilience.
Architecting resilience.
Yeah. And technology plays a huge role here, especially transparent analytical platforms that let you blend e-commerce with specific cause initiatives. We're seeing entirely new funding mechanisms emerge.
Like what?
For instance, innovative systems are being built to allow cause campaigns to be funded via digital receipts or through blockchain transparent methods.
Okay, so a tiny percentage of the transaction just automatically goes to the cause.
Exactly. Blending transaction finality with full accountability. This attracts an ethically minded consumer and investor base that values transparency above all else.
Ghamari also details a practical way to start lean, which I think is often the biggest hurdle for companies.
It is.
He says, first, companies have to audit their audience values. Use sophisticated digital analytics tools to understand where your customer base truly lies.
You can't guess.
You can't guess. Then pilot a micro-campaign, something manageable like donating just 1% of select sales to a cause that you know is deeply resonant.
And the expected ROI on these initial pilot campaigns is quite clear. The data suggests you should see, 15 to 25% uplifts in engagement rates.
We saw this with Vice Media, right? Their tie-ins with the Trevor Project.
A perfect example. That cause-driven content yielded returns 3 times higher than their traditional ad campaigns. The audience engages because they feel like they're participating in something meaningful, not just consuming content.
But the research really stresses that authenticity is non-negotiable here.
Absolutely. A mismatched cause can erode trust much faster than it can build it. The true success stories are the ones that genuinely integrate the cause into their operations.
Not just their marketing budget.
Not just their quarterly marketing budget, no. Starbucks offers a great model of this. Their community store model, which blended coffee sales with local hiring and training initiatives. It achieved a 28% sentiment shift and an 18% sales bump in pilot markets.
Because the commitment was tangible. It was local.
It was real. You could see it.
So, to bring us full circle, CRM is a potent, sophisticated strategic tool. It's for boosting your image, yes, but also for increasing retention by up to 30% and significantly enhancing investor appeal.
It goes far beyond just feeling good.
It's about architecting financial resilience and securing future profitability in an era of, well, persistent uncertainty.
And as brands look to scale this globally, the strategic thinking has to expand beyond national borders. The Economist's broader work, which is informed by these complex ethical and governance frameworks, it stresses the necessity of navigating cross-border ethical standards.
And getting that right has huge benefits.
Huge. It allows companies to develop diversified revenue streams that are resilient to regional slumps or localized market distrust. It turns a moral investment into a macroeconomic stability factor.
Which leaves us with a final thought. If purpose is now a required competitive asset, a form of necessary risk mitigation, we have to ask ourselves, how might future international trade regulations pivot to mandate verifiable ethical supply chains?
Making inaction the real risk.
Thereby making brand inaction the ultimate and most expensive market risk. It's something to think about the next time you choose where to put your consumer dollars.